I'm Jackie Ware.
And I'm Paul Berry.
And you're watching episode 7
of On Air with Jackie Ware.
Welcome. In today's episode, we're exploring the shift from brokerage to multifamily development and ownership. We'll discuss how market knowledge shapes strategy, the role of data analytics, and how to balance the risk and opportunity in today's landscape. Let's dive in. All right, I have Paul Berry with me here, and I'd love to start a little bit with your background. So tell us how it is transitioning from the brokerage at CBRE to your role as president at Mesa, and what's been some of the biggest challenges and maybe surprises that you've had.
It has been a big change. I was at CBRE for 24 and a half years, focused on institutional quality investment property sales. And the one thing that's certainly a feature of investment property sales is your sales cycle lasts only about 4 months on a typical trade. You get called by an owner, you represent them, you get the preparations, you do property tours, you do the bid process through due diligence into closing. Start to finish about 4 months. And part of the brokerage, the role of a broker being hired in almost every case by the seller is to represent them and try to get them the best execution, which means a strong price. So the marketing materials and everything you put together have a fairly positive bent. You want them to be credible, but you're putting a positive face on it. When you're on the ownership side, you're on the other side of the table. You have to be pragmatic about the decisions that you're making and the evaluations that you do. And so you may look at numbers and say, those numbers seem very aggressive. Maybe they're possible, but it's a stretch. And particularly if you compound a lot of assumptions that are pretty aggressive, you tend to come up and say, okay, we agree with some, we may not agree with others, but on the whole, we're actually placing investors' personal money into the transactions that we do. And so we need to be right. In the brokerage world, you have disclaimers on all the offering materials saying, hey, this is what we're putting out there as a potential case for this property, but do your own homework, which puts the onus back on the ownership side to do the homework, which is what we're doing. That's been certainly one of those key transitions, is doing that. And then I would say also on the ownership side, part of that deep dive is, rather than being more top of the waves and superficial about it, you have to actually do a lot of deep work to understand the properties. And then once you own them, operationally, the same thing. So it's much more oriented towards people that are detail oriented and frankly have more patience than it was required in the brokerage business. So it's just, that's just a fact. And an interesting transaction, you actually take a lot more, not only literally ownership in the properties, but in terms of how long your involvement's going to be. It's not going to be for 4 months. It's going to be for a period of years, 3 to 10 years. You really get more vested in the assets themselves during that process. Let's see, what have been some of the surprises? I'd say almost every transaction, let's say at least 2/3 of the transactions that happen in the multifamily business year in, year out, have purchase money financing at the closing table. When you're on the brokerage side selling the properties, you award the property to somebody who's gone out and they're working on their mortgage, but you're getting updates, but you're not having to be in there doing the sausage making of actually getting the mortgage. And you really don't know how vulnerable the mortgage terms are relative to to what was originally agreed upon, right? So when we awarded, as a broker, when you awarded a deal to somebody, let's say you won the award at $60 million, you expect 60 days, 75 days later, that's the number on the closing statement, almost regardless of what happens. What you may not consider is the fact that interest rates can be bouncing up and down all the time. And not only does it affect what the interest rate is, but it affects the mortgage balance. That's one of those keys too, is that last 30 days going into closing, a buyer's agreed to the pricing, they've done their due diligence, but they don't yet have their mortgage, generally speaking, nailed down. And as those interest rates bounce around, mortgage balances can change dramatically. This morning, for example, I was just thinking through in preparation for this discussion, how big is that impact? The difference on a $60 million deal you would take, that you would be buying today, the mortgage that you would get today based on, say, a 10-year treasury in the low 430s versus 1 month ago when it was 480, has an impact on the mortgage balance of about $3 million. So that's $3 million more that you'd be borrowing in the mid to upper fives today that you would have had to have funded with equity if it was 30 days ago. And debt, obviously, in the mid fives is a lot cheaper than equity, where we're trying to get teens returns for our investors. So we'd prefer, while having prudent mortgages, we still want to try to have mortgage balances that are pretty full so we can enhance those returns for our investors. So that part has been a surprise as to just how volatile it is.
Yes, it is. And I know we've had a lot of conversations about a lot of recommendations from Pegasus that you have to consider in making a lot of these long-term decisions for these properties. One of the first properties as president that you bought from Mesa was here in Atlanta. How does your deep knowledge of the market influence your investment and development strategy at Mesa?
Great question. What we try to look at is properties, submarkets, characteristics where we think properties can perform better than overall market, both in terms of rents and NOIs and things like that, and then also the long-term investment. So yes, we bought the mill at West Side in the heart of West Midtown. That's a market that's very tech-oriented. There's a lot of, Atlanta's really become a strong tech center in terms of employment. And because this is right there in the heart of it next to Georgia Tech's campus, it's a great location to harness that growth. It also sits within a couple hundred yards of where the Atlanta Beltline is kind of famous and largely famous for being on the east side. It will be coming in within a couple hundred yards of Mill at West Side, and that installation should be complete before the end of 2026. So we look at that wherever the Beltline has been activated, it really provides great lift on rents because residents understandably want to be able to use it. We look at things like that and we say, okay, we're buying a property that would probably cost $375,000 a unit to build. We bought it for $250,000. It's walkable to the best retail and lifestyle entertainment on the west side, and it's got the Beltline coming. So even though you've invariably in a marketed deal, you're going to need to pay more than you necessarily would have wanted to, we still look at the characteristics of West Midtown and the mill at West Side and say, okay, on the whole, we think we can perform very well over a hold period there. Within a month of that time frame of buying that, we also bought some entitled land up in Woodstock, Georgia, in Cherokee County. For much the same reason. It's not that we're voting for infill versus suburban or one versus the other. It's Cherokee County is growing well. It's got a strong population growth, affluence, got good school systems, low crime rates. It's got a lot of things going for it, and we know that's a property that will perform well also. So we're bullish on that for similar reasons, and the fact that we think there's a really good outlook for the next 3 to 5 years for Cherokee County, just like we think there is for West Midtown.
That's wonderful. I love both of those locations. I think they're both going to be very, very successful. So how has your background with the brokerage influenced the way you structure deals and securing financing or even managing the assets at Mesa?
Another great question. We tend to, based on our investor base and our strategy, kind of go with a good risk-adjusted return. We are not trying to take inordinate risks to necessarily pump potential returns up. So we underwrite with just our equity that we control and the bread and butter type Fannie and Freddie type mortgage if it's an acquisition. If it's a development, it's our own equity, and it is commercial construction loans from banks that we have relationships with. We're not trying to push the loan to values up beyond where they should be. We're not trying to bring in layered mezz and pref and things like that can theoretically get you a higher IRR on your own equity, but it puts more risk in there with regards to the financial performance because of the capital stack. So we try to go with more of that bread and butter, get good returns by buying or building excellent properties in good locations, managing them really well with Pegasus's help, but not taking the kind of risks where we feel like we would jeopardize our clients' returns and put them at risk.
Wonderful. So what are the most critical factors you evaluate when deciding where to develop or how to acquire multifamily properties?
So we're looking for locations that have population and job growth. Ideally, they have some barriers to new development. We may be buying there, but we don't necessarily look at lots and lots of additional properties being added to the supply during our ownership period. Ideally, we want good schools. We want good average household incomes. We want quality jobs that aren't necessarily tied to one major employer or things like that add some stability and growth to the population. And we want to already have a reasonably healthy supply demand with good average rents. When we're looking at acquisitions, particularly now, we're looking at where we've gone through nationally in our Sunbelt locations, we're looking at almost historic levels of new supply. And so there tends to be an overhang. It presents an advantage in a way because we can buy very nice properties that actually are competing against so many other properties that there's concessions and there's things going on that are holding down NOIs, and we're buying based on sort of cap rates on almost existing performance. And in a way, we're able to buy properties at or below a replacement cost on a fairly regular basis, like the mill at West Side is an example. We believe that those submarkets are going to self-correct as there's very few starts now, whereas 2-3 years ago, there were a lot of starts. That's where the heavy delivery wave is. And I think maybe it was, 450 something thousand deliveries in 2024. Interestingly enough, nationally, there was over, 530,000 absorbed. So even though we went through this huge supply wave and those units have to get absorbed nationally, and I'd say in our Sunbelt cities, we're actually seeing absorption tending to outpace deliveries, but it takes time. And so what we're hoping is that with very few new starts, we get into that situation where there's a little bit of a supply constraint relative to what residents have options for, and that'll help us push rents up at a faster than inflationary rate. Development is much the same, although one of the tests there that we have to look at is if you looked at the rents of existing properties, some of which are working through the same overhang challenges I just mentioned, you want to be able to look at that and say, okay, if we build this property and with the cost of the land and the entitlements and the construction and the lease up, when you bundle that whole cost structure together, are we able to confidently feel that we can get at least, say, a 6.5% yield on that total cost using today's rents and construction that rolls out over 24 months plus a year of lease up? When we feel we can meet that metric, it seems pretty good, but that's a tough thing to find these days. So it really is having us focus on places that don't have a lot of supply in those submarkets and even those cities, and at the same time try to really control the costs.
Yeah.
So we spend a lot of time trying to make sure that every dollar on that build up to the construction budget is a value add, that we're getting good value relative to what will residents pay for the costs that we're adding and the features that we're adding.
Yeah, that's great. So with all those different metrics in play and in the market being a little volatile right now, what role does data analytics play in your decision making?
It plays a big role. We read everything we can get our hands on. We have a very sophisticated investment model and development model. And so when we put that in there, we're automatically looking at data from, let's say, Reese and CoStar and Yardi Matrix and other sources. We get all the major brokerage firms' data reports. We get those from other sources as well. And we try to, and they don't always agree, right? Whether it's what is occupancy today, what are average rents nationally and in different cities and so forth. But you can look at them and blend it a little bit and come up and reaching out to Pegasus, what is your experience in your portfolio, and try to put those variables into this sophisticated model and see where we think those values come out. Mm-hmm. And then our model also has sensitivity tables. So you can say, okay, if we invest in this property and rents are $100 more than we think that over a whole period, or $100 less, or exit cap rates move around, how will that impact our returns? What we'd like to see is confidence that we're going to hit the targeted returns for our investors, but also insulation that if things don't go well, we still do fine. Still do fine. That's a key part of that model, is really getting that information and trying to gauge it. And we're believers that the market's going to recover, as I was mentioning. And so I think sometimes organizations have a tendency to be cautious at times like now, and we try to be pragmatic, but we're not so cautious that we sit there and we're waiting until every economic variable out there is like an A+ before we're interested in getting in the market, because we actually think we'll miss the best opportunities if we were to wait that long. So again, we try to gauge where we think things are, where we think they're going, and make the wisest decisions that we can.
I know Mesa's got a great history of that, so I'm looking forward to seeing how this next trend works. I want to move into market trends and competitive landscapes. So what market trends do you see shaping multifamily investment and operations over the next 5 years?
Another great question. Market trends. I think part of that is going to be driven by population flows. We're all fortunate to be down in the Southeast with a Sunbelt focus. And when you look at the top states and MSAs for population growth and job growth, they tend to be in Sunbelt states. So we have this wind on our sails in terms of how the industry will perform. And then it becomes a matter of, well, pick the right properties, right submarkets, right things to where you think residents are going to want to live. Hopefully there's more people, a lot more residents, renter residents, how do you deliver to them the product that they want and in the locations they want? And I think that there's some efficiencies that can be derived out there. I saw the podcast that Justin Jones had done, and It was pretty fascinating from the standpoint we're so invested in trying to buy deals and finance them and build them and get operations rolling that we're not necessarily, certainly Mesa is not necessarily on the cutting edge of understanding where artificial intelligence may take efficiencies down the road. But it was interesting to hear that and say, okay, if we can deliver a better resident experience by freeing up the time of the on-site staff and the regionals and everybody involved in the property, the residents are going to be happier, and we can deploy those saved hours into uses that provide more value add, right? So that's something that I'm hoping really evolves.
Yeah. I think everybody's looking forward to seeing how AI can really take multifamily to the next level.
Yeah. In terms of the properties themselves, I would say what's interesting, if you've been in the industry for several decades, as I have, and you've seen it as well, is there's a really nicely designed and laid out apartment, a 1-bedroom or 2-bedroom, is always in demand. We're underhoused as a nation, and so there's going to be demand. There's features that at this point have become standard, even on mid-quality Class A. It's like you've got to have granite or quartz, you've got to have undermount sinks, stainless appliances, faux wood flooring. A lot of these things are standard in the units, which residents today probably have no idea how good they have it compared to properties from the 80s and 90s. At the same time, I would say property amenities, there's some that become trendy and then they go through their period. And so if I had to look back at examples that I've been involved in, like there was a time when these grand interior theaters with stadium seating and things were the rage. And you're like, okay, well, over time, they didn't really get the use to justify the square footage and the cost and things like that. I think some of the amenities that are really taken on today actually have a lot more staying power. For example, pet parks and pet spas.
Yes.
It's just my perception that the number of residents that have pets in any given property is higher today than it would have been 10 or 20 or 30 years ago. And as a dog owner, and I know you're a dog owner, it's like people tend to pamper their pets. And so if you're able to provide a great experience for your pet, it adds to your resident satisfaction. And so I think that's one of those amenities that does not go out of style. Great pool environments that feel luxurious are great. I'd say people seem to be getting even more into fitness over time. Mm-hmm. So expanded fitness centers that have pretty robust offerings with regards to cardio and strength and cross training and things like that. Whenever I'm in any units that we look at, there's always people working out. And I'd say having a quality fitness offering is certainly one of those things that's become needs to be almost a standard these days.
Yeah.
So there's plenty of features like that I'd say are non-trendy.
I agree. You're absolutely right. One of the things that I remember, every property for a while had a volleyball court or the bocce ball court, and you just really don't see those anymore either. Yeah. So there are different amenity trends that kind of trend in, and then we see trend out. But you're absolutely right.
And in Atlanta, if you go back to the 80s vintage properties, everybody had 2 tennis courts.
Tennis courts. Yeah. Now I have properties that are converting them to various pickleball, fastest growing sport in the U.S. We'll switch a little bit. Are there any legislative or policy trends that have significantly impacted multifamily development and ownership?
One of the things that you certainly learn when you're with a company like Mesa that does development is how involved the entitlement process is. Just getting through permitting and approvals. And if we're going to buy land, we're going to try to buy it fully permitted with land disturbance permits and everything. But even so, just getting from the day that you are ready to contract for the land to the day you can break ground requires a lot. So that process, it slows us down. And on the other hand, to the extent you own properties or you've got some under construction, it's almost a help to sit there and go, well, it does create barriers for other people in terms of additional development. I would say there's a serious lack of affordable housing, and that gets a lot of press, and it's real. When I was talking about that yield on cost earlier, that's market rate land. It's a quality property, but it's not trying to be ultra luxurious. And you still probably, in a typical deal, we would need nearly, say, 2,000 rents in a suburban Sunbelt location. Go through all the math and figure out what can that justify yield on cost? It's like up to maybe $245,000, $250,000 per unit. You can't really build anything almost any cheaper than that. When you say, how about people that need to be at a much lower rent spectrum? Like, well, you almost can't create entire projects less costly unless you can cut the scope down to some extent, but you also almost need help from the standpoint of like tax credits or tax abatements or something like that, that changes the overall economics. So that gets back to what are your municipalities willing to do to help create additional unit count designated for affordable. And generally what happens is you're saying if it's workforce housing, those are people that need to have pretty reasonable commutes to wherever the job is. So it's not necessarily good enough to say you can save money on cost by going 30 miles out of the city and building something. You're like, how does that person make their 30-mile commute? It's a lot better if they're a mile or two from their job. Therein lies a lot of times there's resistance on in-town neighborhoods, especially ones that are near these job centers and everything, to try to have much affordable housing added, or any housing for that matter, but like rental housing. So I think Florida has the Live Local
they do, yeah,
that they put
program
in place. And that'll be interesting to see how that rolls out, where the state basically almost overrides local resistance to zoning to say, look, if these people are developers going to come in and actually deliver units that are hitting a workforce rent spectrum, we're going to override your local objections to that. And we'll see how that goes. It seems in theory like it's a really good program, and I'll be curious to see how it rolls out.
Yeah, we've rolled it out at a couple of properties, so we're also waiting to see.
One other thing I'll say this in favor of the Sun Belt is because we don't have these sort of top-down rent restrictions. That's why a lot of capital is coming from the Northeast and the West Coast, is the concern that if I'm buying a property to hold for 10 years, I want to be able to have that rent growth. And if they get a top-down cap placed on them that they can't, then all of a sudden they're going to miss their numbers. And so there's a reluctance sort of to get heavily concentrated in new investments if there's a risk of that. In the Sun Belt, really, it's much less risk. We don't expect much of that to happen. If you're going to have rent restrictions on a property, it tends to be an agreement right off the bat where you're telling your city or your county, we're going to devote 20% or 40% to some threshold of incomes on the property, but it's the agreement up front versus something that happens in the midstream of an investment.
And you're just kind of stuck without that plan. So how are the rising interest rates and capital market shifts influencing your approach to acquisition financing?
Sure. The interest rates have that huge impact on deals. I said it has risk to it, but it also just the impacts when I was doing that test to say on a typical $60 million deal, how much difference would it have made financing it today versus a month ago where you get $3 million more in proceeds? What if you were to finance it right at a year ago when the 10-year was, I think, at 365? It's wow, you get like maybe $6 million more of proceeds. It's tough to time it, but the interest rates themselves are pretty high, whether it's fixed rate for long-term ownership or whether it's floating for construction type loans. In both cases, they're pretty high. And so it makes it tough. When we're out to purchase a really nice stabilized property that we believe in, and we're up against a lot of other quality bidders, cap rates the price gets bid up to the point where the cap rate, which is what is the NOI divided by the purchase price that you're bidding, that cap rate gets bid down to about a 5 in-place cap rate. And you're saying, okay, I'm going to pay a 5 in terms of the cash flow coming off the property, but I'm going to go finance, let's say 60% of my purchase price. How much is that going to cost me? 5.75%. And you're like, okay, so my lender is taking almost zero risk. They're at 60% loan to value. We're putting in 40% of equity at risk ahead of them. And they're getting paid 0.75% more than we are, more than the property kicks off. And because of the inverse, we may get a 4 cash on cash. They're getting a 5.75 interest rate, taking no risk. That's almost the price of doing business these days because groups like ours are looking more at the total return. Our investor, we have the luxury of having investors that aren't looking for a monthly or a quarterly dividend check as much as they're looking for a total return over their investment. So it gives us the luxury of not being as concerned about that negative leverage of a 5.75 rate versus a 5 cap rate, because we're not so dependent on existing cash flow. We're looking at the cash flow that grows over time plus hopefully appreciation, and that works for us. Now, there's plenty of other buyers out there that are very dividend oriented, and they need a good solid cash return, and it's hard for them to produce that, especially if there's a mortgage on their properties. So it affects a lot of people more than it does us. Yeah,
that's nice to be able to have. I think that's working for your strategy so far. I want to shift gears over to the leadership and growth a little bit. So what are some of the key qualities you look for in your leadership team as president at Mesa?
One of the things that's great about Mesa, we're a pretty small shop. We really have about 10 employees. And one of the things that I've been there just under a year and a half. over that period of time is we really tried to make sure that we're bringing everybody in, consensus building, camaraderie building, aware of some of the key things that we're working on, gets to put their input in. And it's a cross training in a way where, things can get delegated to people and they have enough background and context to really take ownership of different subjects and really make them work. And so I'd say that's one of the key things, is almost one of trying to make sure that we are building that internal collaboration and consistency where everybody's psyched up and the morale is high and everybody feels they're empowered to add value. And in fact, because we're such a small organization with so many things we have to get done, everybody by necessity has to wear multiple hats.
Yeah.
There may be areas where one person's the lead because they're a specialist, but lots of the other people on the team have awareness and can help add value when needed.
All right. With your vast years of experience in the brokerage, what advice can you give brokers or real estate professionals that are looking to transition into ownership and development?
It would go back to some of the conversation earlier in a way where the ownership side of the business is just far more detail oriented. You have to drill down and understand so many more subjects, and you got skin in the game because it's your money and your client's money. And so somebody really has to be enthusiastic about having a detail orientation and sticking with something. And going back to that sales cycle in the brokerage business, from the call that says take it to the market to the closing date, 4 months, deal closes, everybody's hopefully happy with the result, but that's the end of the transaction. On the ownership side, that's the beginning, frankly. Now you own it, you need to run it. You need to achieve the business plan that you put in place. So you have to be fine as an organization. And even if you're a broker transitioning over ownership, you have to be enthusiastic about, I want to actually dig in and be involved with this property for a period of years to achieve a business plan, not just 4 months.
Yeah. Nice. So what lessons have you learned, or have you learned anything on any deals that didn't go as planned that you can share with us that maybe shaped your approach moving forward?
Okay. One of the first acquisition attempts that we had here in Atlanta was a nice, it was, I think, 13-year-old Class A minus, nice deal in Duluth, Georgia, which is part of Gwinnett County. $59 million transaction. I think it was like 258 units, something like that. It was a nice bread and butter deal.
Yeah.
So we were pursuing that, and we were invited to be part of the best in finals. And when we were saying, who are we competing against? For a property of that size, of that age, of that nature, you would be like, maybe it's just other private levered buyers like ourselves. And you're like, we're up against one of the nation's most prestigious and largest pension fund advisors, up against one of the largest New York Stock Exchange traded REITs, up against the eventual winner, which was a Japanese institution that wanted to put money in multifamily. So you're like, okay, so whereas we think we're great and we're big and we have a great track record, you look around and go, that was really a situation of going, okay, in many instances, it's going to be David versus Goliath, and plenty of Goliaths, right? These people have, where we're going out and saying, here's our equity and we're going to go try to get this mortgage. These people have money in the bank to just sit there and go, here's a check. We own it. So that was certainly an awareness generator for all of us in terms of, okay, this isn't going to be as easy as we might have hoped it would be.
Yeah, the atmosphere is certainly very competitive now. We have many clients that we'll have multiple clients going in on one deal itself, or we haven't really seen that in the marketplace before, just kind of some of the things that are going on right now. Looking ahead for Mesa, what are some of the long-term goals, and how do you see the company evolving over the next couple of years?
It'll be great if Mesa is one of those evergreen companies that 20, 30 years from now is just doing its thing and doing it well. We're growing, and I think what we have done and will want to do is to have prudent growth. We're not a group that says, gee, we're going to just have explosive growth and raise these enormous funds and go out and cover the United States in acquisitions and development deals. I think what we want to do is make really smart decisions and have good, prudent growth over time. I think that's what our investors want. I think it's what our two founding partners, Tom Bell and Jeff Tucker, I think that's what they want. And so I'd say that's what we're going to do. And hopefully we've got a good core group of people. I know we got a good core group of people. Hopefully we have a core group of people that want to stick with the company and grow it and have this prudent growth, and that we can all look back a decade from now and say, wow, we've grown, we've created a continuing legacy of successes, and we can take pride in that. It doesn't mean that we're as big as one of those giant REITs or pension funds. It just means that we have achieved what we've set out to do.
Yeah. I know there's no more influential person to be around than Jeff Tucker. You're always, he lights up a room completely. So, final question here, Paul. What excites you the most about the future of multifamily real estate?
To answer that one, I'll actually jump back. When I came out of MBA school, actually in 1990, and went into real estate, and I was on the ownership side really for the first 9 years or so before moving over to CBRE. And during that 9-year period, I was involved in a lot of office buildings, industrial, some retail, some for sale, residential. And as I looked out there and decided I wanted to go into something that was very transactional oriented in investment properties case, it's a full commission position. You have to win listings and execute them to get paid.
Yeah.
And so I looked at it and said, if I'm going to be in this for my career, I'm going to pick the product type that, with my experience, which by the way included multifamily, I'm going to pick the one that I actually believe in the most. And far and away, the one I believed in the most was multifamily. And that's proven to be, in my opinion, a great decision. I've never second guessed it in all these years. And it goes back to the fact that we provide something that I actually don't believe the other product types necessarily do. We actually provide something that people desperately need. They need a quality place to live. And I was just thinking through the statistics. It's like, probably if you looked at any of our residents' year and 24 hours a day times 365 days, you'd say they probably spend 50% of that entire year in their units and on that property. 50%.
Yeah.
I said, how is somebody that works a 40-hour a week in an office building somewhere? So that's less than 25%. How about if you added up all the times that they're shopping in retail centers and at restaurants and entertainment, and you're like, my guess is that came out to like less than 15%. So I'm like, okay, we're multiples of the time they spend in the other product segments in ours. And it's more central to their life. So to me, I look at it and I say, I like being in an industry that has a purpose as much as ours does. And I think back to the times early on when I lived in various apartments moving around, and I can distinctly remember the apartments and the friends that I made and the resident activities and the way I felt in the property and in the neighborhood. And then I think back to all the office spaces I had at the same time. I'm like, I barely remember them.
Yeah.
And if somebody said, what was the grocery store like you used to shop at? I'm like, I can remember driving to it, but do I remember where they kept the eggs and the milk? No. And that stuff is faded because it really didn't have the same importance as the place I lived. And so I'm like, okay, we provide the places people live. We provide the memories they're going to look back at. And I consider that to be a really worthwhile thing over and above any of the economics and stability of what we do. I'm really happy that we're all in this industry.
Well, that was a perfect ending, Paul. I want to thank you so much for you coming in today, taking time out of your busy schedule to come meet us at our humble podcast studio. And I just really appreciate your time, your insights, and I hope our viewers got a lot out of that today. Thank you.
Thanks, Jackie.